Who has made a stablecoin transfer? Raise your hand. Everybody on this panel should be raising their hand. Okay, maybe not you, Ivy. Who has made an FX swap or transfer? Raise your hand. Oh, this is pretty good. You know, small sample size, but still good. I'm Tesa. I'm the head of market research at Flashbots. We have a great panel today. Just to give you a heads up, $9 billion worth of FX stablecoins are traded annually, and we're going to compare that to the $9 trillion FX that trades off-chain. So this is a great market. We're going to get into it. My panelists, please introduce yourself and your company.
Hi, everyone. Happy to be here. I'm Schuhmacher. I'm from the digital assets and currencies team at Deutsche Bank.
Hi, I'm Martin. I'm doing BD for Curve. I have original tech background, and I'm sitting here because we have something called FX Swap, who is doing well for FX.
Hey, everyone. Denney Kwok. I'm from Mento Labs. I lead product here. FX stablecoin platform enabling what we're talking about today. Yeah, I build all things product here.
Cool. We're going to deep dive into, I think, FX market structure at first. So we'll start with Denney. Denney, with Mento, you use a hybrid model for your stability. Do you want to kind of briefly describe what Mento does differently and the stability mechanism that you have in place for your major FX pairs?
Yeah, awesome. For those of you that don't know Mento and what it does, we're a stablecoin platform. We have, similar to what Polaris talked about earlier, we issue decentralized stablecoins backed by USDC, USDT, and other prime stablecoin assets, fiat stablecoin assets. And what we have is this novel mechanism called FPMMs, fixed price market makers, which leverages Oracle price. So instead of doing price discovery on chain, we bring the 9.5 trillion FX market from TradFi on chain and bring that rate so that you could swap with no slippage. There is still this dichotomy of what happens when traditional FX markets close. So the FX markets, for those of you who don't know, are open 24/5. So basically from like London to Japan to Sydney to New York, et cetera. What we do is we flip to a hybrid AMM model over the weekends, and we have circuit breakers to ensure that like trades go through and that there's no losses for LPs and things like that. So what we've really done is, instead of having price discovery on chain, what we do is we enable we bring prices on chain, and that allows you to swap, for example, a BRL for a JPY at the given FX rate, or we're in Europe, so 1.15-ish plus or minus euros for USD at any given time, with no slippage and not relying on market makers and arbitraging to bring what we all know is like Uniswap or other AMM models, Curve, AMM models. So it's just a different approach. There's pros and cons to each, so yeah.
Martin, you're part of the Curve OG concentrated liquidity pools for stablecoins. How have you modified what Curve has done for FX stablecoins?
Yeah, so the initial, I would say, we basically, our founder invented StableSwap, but even at this time, FX was some kind of dream or target market, basically, and then we had like a crypto swap, who is for non-correlated asset, who worked pretty well. But we made recently an iteration on this, and we call it FX Swap, and yeah, we are like all in, basically one of the reasons we are in the camp of have auto-managed liquidity, basically, so the system is basically rebalancing itself on the spot where the trading is happening, and it's a very good solution for low volatile asset, basically, also for real world asset, but also for FX, and because FX is now, yeah, we see more and more non-US dollar stablecoin coming to the market, basically that's the first market we want to move into, basically. And yeah, I think we are in the, yeah, it should be auto-managed, basically. We see system where asset issue has to manage or liquidity provider has to manage the system themselves, and I don't think that's the future. It has to be simple and reliable, and yeah.
Cool. Ivy, You're from the banking world. Deutsche Bank is one of the largest FX currency, I think, banks. What needs to happen, I think, for the banking side to actually come on chain? Like, what is missing in the FX market structure on chain today?
Yeah, I think I start with maybe the positive side. We already see like there's like a tech side, there's a solutions, which is, let's say, think about the FX transaction life cycle, then the price discovery. Let's say it's for especially like major currency pairs, it's easy, let's say, to quote or import a quote from the off-chain market, right? Because it's a fair rate. And also we can also, regarding the AMM solution, it's quite stable, right? And the question is really when we move into more emerging markets and also under stress situations, then it gets trickier. And to your question, I think bank in the traditional FX transactions, right? As a, let's say, a liquidity provider, we don't just quote rates, right? There's two key topics. I think we are still dominant, to be honest. One is the liquidity provision. It's our balance sheet that how we kind of either through internalization or through certain hedge strategies, we basically transfer that risk from the clients and to our balance sheet, and we do have the capability like to absorb, right, especially for largest institutional tickets. So this is one thing. And second thing is I think there's these controls, right? So all types of execution controls. I think Tony just mentioned in the previous session to say what happened. So we need to know our counterparties, who we are trading with. What if tomorrow they are gone, right? What if I cannot trade as the supposed to be kind of rate, right? Because of the DPAC risk, because of the illiquidity and so on. So I think this is where we do a lot of validity check. We do credibility check. So that to ensure really, from a last look perspective, that we are offering a firm and executable quote that will take place, right? This is a kind of certainty kind of from a bank as a liquidity provider perspective we can offer.
And this is for a group question. Right now, you're seeing major stablecoin FX pairs. For emerging market FX pairs, how do you anticipate bootstrapping liquidity in those markets? Or what have you seen? Or maybe for you, Ivy, what normally happens in TradFi for emerging market?
Do you want to go first?
Yeah. It's just interesting. What I see is like for the very deep liquidity, big pairs with low volatility, on-chain is not really competitive right now. But what we see, or we have pools with more like second quality currencies basically, and they have product market fit in the sense that they bring the flow themselves. So it's more like emerging market because looks like people have much more need or are willing to transact on chain because some of them also have like the hedge back into USD basically. So and these pools have quite a good traction, and the dirty secret of this is because it's more, sometimes it's not a mainnet, so it's not competitive. So basically they're the only venue who this token can be traded, and then you don't have to set the fee very low. So basically you can set the fee where you make some revenues on the capital. So it's like, I think the more competitive it gets, mainnet or also other chains who have like a deep liquidity of different non-US dollar coins, then there's almost no money in this market basically. But if you go more out to more like, not exotic, but other currencies, then it's different landscape. And I think some of the push will coming more from this side basically and less from the institutional side, on on-chain side.
I think that's a very good point. Looking at the major pairs, so like Euro, GBP, JPY, so on and so forth, on-chain liquidity just can't compete with fiat liquidity. There's literally trillions, which is like exponentially more than the Bitcoin market. I think the way I would look at like on-chain utility for those pairs is that you can do certain things that you can't do in TradFi markets. So you can settle on weekends. You can actually use, Circle has this like instant redemption rail where you pay a little fee, but it's still like cheaper for you to get into fiat instantly through stablecoins as opposed to like through the international wire system. So you can send money from like Europe to Japan much more seamlessly, although it's capped by the liquidity limits, obviously. Yeah, I'll touch on the FX stuff, but I want to give Ivy a chance to, or the emerging market stuff. I wanted to give Ivy a chance to.
Right, I think we covered like different models, right? I think there's one maybe I can add to is, I mean, traditionally we have this RFQ or RFS kind of style, you know, basically dealer-based, right? So we, for example, as a bank, we can be one of the dealers, but then you also have other, let's say, regulated and non-regulated financial institutions and so on. I think this is probably something, it might be a solution, let's say, for emerging markets, because it's, let's say, what happened there is really, there's a capital control as example, right? So basically you cannot, you actually don't know what's a fair rate there. And a lot of, most of the cases, as mentioned, you know, you might have a big dealer there already internalized the flow, so actually not every flow is pushed to the pool. So even if you have the access, that whatever the rate you access is not really the fair one. So I think this, let's say, this dealer approach is similar to what the TradFi currently is, you know, applying. And if you're a little bit like a positive, like solution-oriented thinking, I think this, I think we all appreciate like the smart contracts based flows and also leverage stablecoin in terms of post-trade. But for the pre-trade piece, we can think about near-term, maybe some hybrid approach, right? So in terms, especially for certain stress scenario or emerging market, you know, I do feel like this RFQ and RF, as at least short-term, it can be a really attractive offer or alternative. Yeah.
I think that's super interesting and super compelling because I think we oftentimes live in this world where it's, you know, binary, where it's like one way or the other way, like Onchain or TradFi or whatnot. I think the RFQ model is really, really important, and I see there's this like hybrid approach as we kind of like develop these markets where the blockchain kind of becomes like the settlement layer, but like liquidity can come from anywhere, and if like firms like DB or other firms kind of plug into these systems, it really enables like a lot more things to happen and a lot better capital efficiency, and it just becomes kind of like a settlement layer where things happen, and there's this like trusted layer that sits under all the liquidity from whatever source it is.
Yeah, exactly. And just also to add, it's not just a capital, right? It's also, especially for emerging markets, there's also about expertise, right? You have certain scenarios that you really need such a manual intervene. I completely agree. I really appreciate all the types of, I think bank perspective, we really appreciate all types of automation, where you're kind of in the era of automation and blockchain. But just but we need to think about whether we can build in such like controls, you know, like manual override capabilities, right? Instead of let's, yes?
Okay, that's yeah, challenging.
So on that topic, what happens during volatile events? Martin, what happens to Curve? Like, how does Curve's internal oracle protect LPs during a volatile events?
Yeah, that's interesting because if you're a DeFi, on-chain guy, it's different. And one of the models we see with the tick-based model, basically Uniswap V3 and many copies of it, the issue there is you own liquidity or somebody owns liquidity. You set your ticks where the trading is basically. And every time there's volatility, the price moves out of the range. So basically trading stops, and that's worst case basically. So this means the market just disappears. And the reason is also, even if you're like a decent, assume that you are a liquidity provider who wants to basically guarantee liquidity all the time, you have to withdraw, you have to reset to some range, and at this point, you also lock in loss basically. So it's always a decision. Maybe you think, yeah, the market's coming back tomorrow to the same price, so I just stay out. It's not that our system, curve system, it's not that you also can go out of the market anytime, basically. But because you don't have to manage it, so the liquidity is unified, so all liquidity of all the participants basically is treated the same, and is also shifted the same way, automatically. So basically, what we do, and we also do this in backtesting, we backtest 5 years volatility, and then we see that basically in this condition, it should be, if you assume the future will have the same volatility, it will always be in the best tradable range, basically. And yeah, our system is not disappearing in these adverse scenarios. And we did see this in many, on the USDC DPEG, basically, curve then basically is a secondary market for on-chain liquidity, because sometimes it's only venue where it still gets traded assets. Even possibility, people could also withdraw the liquidity and not expose them to this kind of risk, but you also make a lot of money in these markets now, because then, yeah, there are a lot of trades, so you make a lot of fees. So I think because our system is more passive, it allows you to, you don't even have to manage it yourself. So of course you can monitor it and then go out of the market, but that's not what we're seeing, basically. So we are more resilient by design, basically, because the friction to disappear is like higher than to stay in, basically.
Denney, do you have any sort of features that in your FPMMs for high volatility situations?
Yeah, so we actually take kind of a different approach to a lot of what on-chain builders take. We actually take a more similar approach to like TradFi and equity markets. We isolate each of our pairs, and we kind of have like a quantitative circuit breaker set to each one, similar to really highly volatile times in equity markets where trading halts. But for us, we see this as a feature, not a bug, because in those times, each of those pairs are isolated. And one of the things we've seen in DeFi happen a lot is, especially because we rely on oracles so deeply, we've seen like Oracle attacks, we've seen Oracle failures like completely drain LPs. So this is a feature to actually protect LPs under the hood until kind of these circuit breakers are lifted. So yeah, it's a slightly different approach to most of DeFi, but we really see it as like another mechanism to protect LPs. During several of the kind of black swan events over the last several years, we've been able to maintain our peg and come out without any losses for our LPs. So yeah, we're pretty proud of that.
Ivy, since the banks are mainly, I guess, prop trading on FX swaps, what are, I guess, the legal, credit, and capital conditions that need to be in place for you to feel comfortable to be able to scale your FX business on chain?
Right, so we talked about the liquidity provision, and now it comes a little bit like dry legal side, which is very important for, let's say, regulated financial institutions. I think firstly, legal certainty, as you mentioned, right? So I think for, let's say if our clients is a large corporates, right, they need to really understand, okay, if I have a dispute, if in case of insolvency of my counterparty, so which law is governing this transaction, right? And I think in general, there are some development from regulatory side, right? I think English law is generally very open, like they do allow like embedded, let's say, smart contract, in their law, and also ISDA is working on some, let's say, tokenized collateral framework, yeah. But again, this is just, we only see like silos, right, currently in terms of the reg development. It's one jurisdiction. If we're talking about FX, cross-border transactions, you actually need to really align the standards, and it's really about in all the relevant jurisdictions, right? And I think you mentioned also capital requirements, right? Because this is probably on more like a bank perspective, because whatever the role we are playing in the future ecosystem, right? Whether we are issuing, let's say, stablecoin ourselves, so it's on our balance sheet, or we just like, let's say, pass through. So for example, we offer some like a wallet infrastructure and so on. It's a client stablecoin and so on. It's gonna somehow land in our book or pass by, right? And the regulator, from the prudential requirement perspective, they're very strict, right? They say, okay, what kind of tokenized money are we talking about right now? is it a regulated stablecoin? Then we probably categorize them, let's say, under Basel currently as 1B, right? Then we don't have a very harsh, let's say, capital treatment, right, for us, like in terms of the buffer and so on. But if, let's say, certain criteria is not fulfilled, right? For example, redemption, standards is not there, or there's no strong governance of the issuer side, right? So then they might up at a very unregulated stablecoin category. Then we are really talking about a huge capital buffer that we have to reserve for such a product, right? So this is something like that. It's not a showstopper, but it's something we definitely want to look into before we just say, yes, we're on, we want to bring everything on chain and so on.
And then this question is for the group. If you wanted to trade, I guess, in emerging market currencies, you have a very wide spread in just natural TradFi. How have you seen Onchain kind of minimize this spread, and what sort of ways, or what is the mechanism that has kind of decreased the spread that you've seen?
I can take that. This is actually the killer use case for Mento and Mento's platform. Looking at the major currency pairs, it's really hard to compete with what a lot of the TradFi firms offer their enterprise clients. But for end users, and what we're really trying to build is democratize access to these markets. Because we take an aggregated rate from the global FX pool, we're actually able to offer a very, very tight spread on a lot of these emerging market pairs. So we have several African currencies, we have several Latin American currencies where we're able to offer it at pretty much the best rate you can get from an enterprise client of a Deutsche Bank or any of the GSIB banks. If you look at one use case, just to put this into perspective, I'm from California. A lot of folks send money back to Mexico, back to their family or friends. Remittances, that's a tighter corridor, but remittances to some more emerging markets can be up to 6 or 7% to pay. And there will be fees on platform side on crypto applications or DeFi applications or fintech applications, but we can get that down tenfold easily. We have a partner in Opera, the browser company. They have a wallet called MiniPay, and they've basically enabled this through P2P transfers with stablecoins in 60 markets globally. So and they have 10 million users on that wallet. So we really feel that is one of the killer use cases, in addition to kind of B2B and enterprise flow as well. But I think it really hits home when you see the spreads or the money that you can save from spreads for an everyday person.
I would also, that's also the argument basically, because if you send money on a traditional raise, you have to pay much more fee on other places, so the spread is not your main concern at this moment, I guess, if this is the use case basically. And what I see, but this is more in general, the difference between TradFi and DeFi, on FX, if you ask for higher quote, you get a smaller spread. But on-chain, in a way, it's different. The higher the trade size, the higher the slippage and the spread. And I think there's also need some learning experience. I guess if TradFi wants to adopt DeFi, they need to DCI and basically hope to either DCA over time and then hedge the position, however you do that, or you just have a different mindset, because otherwise you always, that's a little bit the question we got many times. This is the trade size, and trade size is high, and then the slippage is so high. And it's why are you doing this? Because it doesn't make sense. You should basically trade over, 30 minutes, and basically hope that that the pool is good arbitrage, and the price basically, you get the mid price over the next 30 minutes, and not just trade in one go, basically.
Which brings me to Ivy. Ivy, what sort of features or what needs to happen to bring TradFi to DeFi? What sort of design mechanisms or features do you need?
Right. Just to comment shortly on the spread part, right? Because that's one of our, let's say, revenue model, right? We as the liquidity provider, we earn from the spread and so on. But I don't let's say I don't disagree, right? For certain markets, let's say the major currency pairs, we do see advantage, especially from user perspective, that might be really a fee perspective advantage, right? So like Onchain, it's less spread. However, if you're talking really about the institutional use case, right, with a large ticket, because that spread with the bank as a liquidity provider they offer, that considers really the ticket size, and especially also whether the market's liquid, so for emerging markets, and the current situation, right? We do believe most of the TriFi, let's say FXs, they're actually bilateral, right? It's very discrete, I would say. And under that kind of setup, the client actually gets a certain quote and gets a really good spread offer. So why? Because it's a lot of things they are internalized. They are not really about like open to the entire market to say let's just exposed to the volatility, you know, like it depends really on how deep the liquidity pool is and so on. So it's again like really leveraging our network, leveraging the whole, let's say the balance sheet, right? So we internalize it, we hedge it, and so on. So this is why I don't disagree, but for some markets I do feel we have advantage in terms of, you know, this offer. Maybe, I think we covered quite several points, right? Both from liquidity provision, controls, and also legal perspective. Maybe just to call out to say, when we talk about bringing, let's say, FX flows on chain, the solutions might be really vary depending on use cases and also on regions, right? For example, in Europe, we have SEPA instant. So then if you talk about within Europe, you make a transaction, then the question is it really beneficial, let's say, to leverage stablecoin? Because we do have other, you know, alternatives, right? And also, let's say there are also from central bank and also BIS, I think there's a project Agora, and the ECB, there's also like a lot of pilots about the wholesale central bank money, right? So these are all like let's say, tokenized money formats that from institutional perspective, we can consider as alternatives. So it's really depend, and they all have, compared to, let's say, stablecoins, both pros and cons, right? So it's in the end really about which use case are we talking about, which corridors, and which rail that make really most sense, you know, for both the clients and the bank perspective.
Look, I think we'd be kidding ourselves if we said we have FX solved on chain. It's still really, really early. And I think like trading is one use case, but I think like I want to put this as like a call to action to all like the builders and partners out there. Like this really only works if we can build kind of a network of different endpoints where, you know, the blockchain is kind of the central node, but if you're talking about remittances, if you're talking about cross-border payments, if you're talking about international payroll and all these things, this really only works if you can get good partners in each jurisdiction, because regulation is really tough in each jurisdiction. There's no one platform or no one like company or protocol that's going to solve all of that. I don't think a protocol literally can solve that because of like regulatory issues. So I want to say it's like really, really early for this, and network effects compound, and it's really only going to get more efficient and better as like more partners, that TradFi firms that look into it, you know, on and off ramp providers. We're in Europe, like we really need SEPA rails to get like a Euro stablecoin to be really like effective and have utility. So what do you think the biggest pain point is for, say, Mento specifically in each of your respective projects or businesses? Yeah, just like really quickly, I think for Mento, we're an infrastructure player. We really rely on like partners. Like MiniPay is a great partner. They have enabled us to access like all these rails in Africa, which are really tough for a lot of people. If you look at the most used stablecoin in Africa, USDT, I think by all measures, how do people access that today? It's Binance pretty much, I think. Someone can prove me wrong, but I'm pretty sure that's still the case. MiniPay has built out like, what is it called, mobile money wallets, integrations with specific rails in like Kenya, Nigeria, South Africa, et cetera, et cetera. Until we see that type of integrations through like every other part of the world, like infrastructure players can only do so much.
Martin, what's been your bottleneck or pain point?
Yeah, not enough non-US stablecoins, basically. It's a little bit true because we have been waiting for them like since ever, and every time it's like, yeah, they will arrive now, but yeah, we see there's some growth now, so I guess we are over this, basically. And yeah, we in a way, we are more like an infrastructure for others to use. So many problems we don't have to fix, basically, so others have to fix it, asset issuers. And we are more like, we are like a deep tech company who have good solutions, and we like offer this to everyone basically because we are open system, and we are protocol. So basically, many things we don't have. So we don't care about regulation, AML, all this kind of TradFi things, which is a good place to be. But we also need like people building on top of us, and many do this in different things. So. Yeah, I guess it's how to scale this basically. That's why I wanted the same question.
Yeah, I would really push a little bit more like collaboration kind of way. So yeah, of course we worry about regulations, right? Not just worry, just because we are kind of in between, right? It's a relationship we're offering to our, let's say, corporate clients as an example, right? It's not, we cannot say it's your risk, it's your decision to use the coin on chain, everything. Then we just facilitate. It's not, it's a really long-term relationship. And also we are regulated financial institutions. That's why we do care about regulation, right? So I just want to make a point on one thing about transparency. I do see that on that front, there was a really good virtually collaboration between like the tech team and also traditional TradFi, right? Because I think a couple of years ago we were talking about moving TradFi for even some sort of pilot, let's say, like an on-chain exercise. We would definitely say that has to be permissioned chain, right? It has to be closed. And we just don't want to expose to risk and so on. But then because of the privacy concerns, the confidentiality, particularly for the pre-trade, right? Because otherwise it would be really counterproductive, and then you have the upside kind of market move and so on. And for the last couple of years, and there's a lot of like tech development, right? So for example, ZKP, it started to solve the privacy issue, and you do see like a lot of tech providers, they try to install, let's say, really bespoke compliance or like a control stack on the permissionless chain, right? So this is something like, I think we are open. In the end, it's really about, let's tick the box. Does it really offer what our clients and we ourselves also as a client are looking for? And then this is something that we do believe there is a potential.
Yeah, just to add something to transparency. Yeah, I think DeFi is very much built on transparency, and it's a good thing in a sense because if there's like the resolve issue, you see in like a day, basically it's visible who is exposed to what, basically. And yeah, I'm just saying as a DeFi guy, on-chain guy, as soon as we start taking away this transparency, we basically lose also part of the potential of this. So it's like, we as an industry, or the DeFi builders, we need to solve part of this, maybe at some point, but it also has like huge side effects, which basically is damaging part of the value proposition we have, basically.
Yeah, agreed. I'm not saying taken away.
No, it's not. I don't say it's not a moral judgment. It's just a fact, basically. I don't know if DeFi works well with privacy built in. I have high doubt. I guess we will lose, part of the value proposition. So basically, it's just more like this.
Yeah, I think transparency is very, very helpful, right, for post-trade. Let's just pick this FX transaction as an example. For post-trade, it's great. It really enforces, let's say, traceability, auditability, right? This is what we want, basically. But for the pre-trade, it's really, especially for large ticket, think about like a big corporate, they want 500 million pay a hedge US dollar, and then everyone knows there's a move, and then they're gonna react, right? Then that's,
Like these outsized oil positions in the last couple of weeks.
Okay, we're down to a minute. I want to open it up to the audience. Does anybody have any questions for our panelists? None? Panelists, do you have any questions for the panelists?
I have a question for Martin, because I want to circle back to the point you made around needing more stablecoin issuers and more liquidity around that. Like, how do we grow? Over the last year, I think I've seen like a lot of really good teams in many jurisdictions issue stables. How do we grow adoption and liquidity as like a ecosystem and as like protocols? I think about this a lot.
I don't know. It's a hard question. As a protocol, you mean? Oh.
Yeah, just like as like we're both like infrastructure layer. We provide like a service to these guys. I think one of the things that they've struggled with is getting adoption, getting liquidity. Like there are no USDC, USDT, right? With like billions of dollars in circulation.
Yeah, I mean, we as a protocol, we can manage the demand side in a sense. We don't see the market. We are not like, we are like, they have clients and they need basically to find, product market fit basically. So for us, it's hard as a protocol. We can give them good technology and they can use it, but at the end, we are just like, infrastructure. It also means the user should not see that we are used basically in the back end. They just should get a good service basically. Yeah. So it's like we should disappear at the end. That's the goal basically. Yeah, same here. We've issued decentralized stablecoins as a means to an end, but I think like my future vision is that there's fiat, deeply liquid fiat issuers in every corridor in the world. Yeah.
Well, thank you guys. Thank you, panelists. This is a great conversation. If you want to discuss more with them, I'm going to push them out to the side or somewhere else, and then you can chat with them. But thank you.